So how are you investing in the U.S. market? Still loving U.S. stocks, I suppose.
U.S. stocks is basically, it's a low beta, more defensive market. So paradoxically, in an environment where growth slowing, the U.S. is not a bad place to be. We still like technology because that's really ultimately where most of the earnings are still coming from. So a bit of a bias there. Plus, to balance things out, maybe the healthcare sector is also worthwhile to look at.
What about, bond markets? The thing is, it's still what it was, 10 years yielding 4.4%, 2-year 4.3%. We're seeing a lot of people crowding in for slightly longer duration at the moment.
Yeah.
What does that tell you? And is that where you're also seeing the juice, if you will, too, looking ahead?
Yes, full disclosure, we've been making that call as well, maybe a little bit too early, but we're still very confident now that that's the right thing to do, to be extending duration moderately. We have this convexity situation in the market. It really plays in your favor in the environment where rate cuts begin to happen. So fixed income is what we're focusing on at the beginning of the year, maybe rotating into equities in the second half of the year more.
And what about geographically now? Let's have a look at what's going on. The U.S. economy is really surprised by its, its indefatigability, one could argue, but Europe not so much.
Well, in the end of the day, Europe didn't do that badly in 2023. I think the market basically rose by 16%, so not as brilliant as other places, but also not that poorly either. Europe, it's all about seeing a resumption in credit growth, and that's beginning to pick up, so maybe some green shoots on that side. But risk-adjusted, we prefer U.S., Japan, and India.
How about China, Stefan? We have Morgan Stanley saying risk-reward, China looks attractive. We know that when you take a look at the CSI 300, it erased all the gains since the stimulus pledge. 8 shares now down 10% in January alone. How do you make sense of that? And what signal are you looking for before you dip into China stocks?
Yeah, this is hands down the most difficult call to make in the market right now because, the valuation is rock bottom. So if you think about a portfolio and you think about upside risk and downside risk, there's certainly room, we think, for a sharp technical rebound in the China market, largely because long-only funds are so underweight at this point and the valuation is what it is. However, the big question is, does that then translate into a more sustainable uptrend in the market? And there we're less convinced. So it is indeed very, very difficult. But being aggressively underweight at this point also is a little bit risky, if I can put it in those terms.
You talked about how you're liking India. Foreign funds have been pulling money out of India over the last 3 weeks. Some pointing out perhaps there is a rotation out of India into other North Asian markets, the likes of Korea and Taiwan, perhaps. Are we seeing a rotation?
I think I'd be a little bit careful about that in the sense that we see India as really as a structural story. Of course, on the valuation perspective, it's the exact opposite of China, whereby the valuations are, I think, undeniably expensive. But India, we have to remember, is an economy that will likely grow 6% plus this year and probably next year as well. And then it's very, very hard to find that level of growth pretty much anywhere in this world. So maybe that is kind of the counter argument to the valuation bit. It's also possible that tactically some fund managers are taking some profits off the table in India. It did very, very well last year and looking for cheaper options elsewhere. Structurally, though, we still like it.
Japan is another one you like, and it was the market of 2023, certainly the surprise, certainly, and that surprise may continue. But what does the Bank of Japan do? And when they do decide to change their monetary policy and their yield curve control, everybody's already positioning themselves for it. So suddenly you're not hiding to nothing, maybe.
Yeah, Japan is an interesting case on the monetary policy side. So you have relatively high inflation and this NIRP, the negative interest rate policy. These two things are inconsistent with one another. So they effectively must at some stage normalize policy. We think the outcome of that will be a stronger yen. And then the big question is that stronger yen going to dampen the performance of the Nikkei? We think the market will look through that and focus on the growth story, the profitability story, and the valuation drivers in the Japanese market.